So today we're going to do an exercise of guarantees. Where can you put your money where it has guarantees? Well, that's what we're going to talk about. The word guarantee should matter. I know we've gotten off of that. We don't put the value on guarantees like we could because we're always trying to shoot it to the moon. We want to grow it to the moon. And a lot of people think that, markets are never going to stop earning, but they are. What goes up must come down. So you need to listen to this word guarantee, because it isn't what you think, it isn't the vehicles that you think it is, and also you're being told a lie. And I'm going to show it by the numbers today. So let's dive in to guarantees. So when we talk about guarantees with your money, where can you get a guarantee? Well, you could go to the bank and you could buy yourself a CD that has a fixed interest rate and is guaranteed to pay you that interest rate for a term of time. I know a lot of people that do this, but there's lots of downsides to CDs, so they're not always the best fit. How about your bank account? Is that guaranteed? Not really. You might have an FDIC guarantee up to $250,000, but if you've got more than that in a bank account, well, it's all bets off. So where else can you find guarantees? Well, you could go to the United States government, you could buy an IOU from them. It would be called a treasury bill or a treasury bond. They are guaranteed by the full faith and credit of the United States government. And make no two ways about it. When the bank guarantees you a fixed interest rate on your CD or anything else, you know what they're doing? They're going out and buying a treasury bond or a treasury bill that backs that money up. And they're making a spread. So if they give you a CD for 4.5%, they probably bought a T-bill or a T-bond that matched the duration of your CD that pays them a little bit more. So if they're giving you 4.5, they're probably making 5, maybe 5.25. You see, that's how they do it. There's no secret. So cut the bank out, go direct to the bonds and buy them, but there's risks there too. Time risk, interest rate risks, don't even get me started. So where else do banks put their money when they want to guarantee? So banks take your money in as deposit, and 10% of that money must be held in what they call Tier 1 assets, guaranteed assets. Well, they buy treasury bonds from the United States government, but what they also buy is a vehicle that you know of, you've heard about, you've grown up with it, but you probably don't fully understand that, and that is life insurance. But more specifically, banks don't just buy any life insurance, they buy whole life insurance, but it's called BOLI, bank-owned life insurance. Look it up, B-O-L-I, Google it, go to fdic.gov and type in BOLI. Find out how much money banks have of your money, their money, you just deposited it, so now it's their money, in BOLI, and that's a lot. So let's just talk about that vehicle. Whole life insurance. You can buy whole life insurance. You can go to your broke-ass brother-in-law. You can go to the agency in your town, and you can buy whole life insurance. And all whole life has the same guarantees. Check it out right here. They have guaranteed death benefit. So no matter what, if you live your entire life, your whole life, and die, they will pay a death benefit up to age 121. But what if I live past 121? They just write you a check at 121. It's called an endowment. So you just get the check for the amount of the death benefit. What else is guaranteed? Well, there's an element of the cash value, the money that you can use anytime you want, that is guaranteed. And it is guaranteed with a contractual interest rate. That's right. In your contract, which is a unilateral contract, they guarantee you an interest rate. So how much is that interest rate? It varies by company, but one of the main companies we use is 3%. Another company is 3.25. Guaranteed for the rest of your life. So if interest rates go down, you're guaranteed to get whatever the rate is the insurance company pays you. So what that means is that your cash value is guaranteed to increase. How's that sound? I love the sound of that. But also, what also is guaranteed is your premium deposits. So whatever your premium is, the amount that you set the policy up to make deposits into it, They call that the premium. We call it premium deposits because we're not just talking about regular whole life. The way we design it, we specially design and engineer the contract differently than the regular off-the-shelf whole life that your broke-ass brother-in-law or broke-ass sister-in-law, hey, it comes both ways, will try to sell you. These are very different, but I'm just getting to the basics of the guarantees. So you've got guaranteed death benefit, guaranteed cash value, guaranteed interest rate, and guaranteed premiums, which means they never go up and they never go down. They're just guaranteed to be what you set them up at. But what is not guaranteed inside of a whole life? Dividends. So not only do you get that guaranteed interest rate, but you also get a dividend every single year. Although it's not guaranteed, they have never missed one. And these insurance companies that we're talking about, they're mutually owned, dividend-paying life insurance companies. Every one of them have paid dividends over 100 years consecutively, never missed one since the day they opened their doors. So although not guaranteed, it's a pretty good bet you're going to continue to get dividends. So when we're talking about dividends, we can't use the word guaranteed because they are not. But the interest plus the dividend, they call that the dividend crediting rate. Right now with most of the companies are between 5.6 and 6.2%. That's what you're getting on your money, of which the 3 or 3.25% is guaranteed. But let's talk about another vehicle that is very prevalent in the marketplace, and that is called universal life. Let's talk about what guarantees that product has. So universal life policies became popular in the 80s, as you can see. So they were created in the 1970s, traditional universal life, and they became really popular in the 1980s. Now these traditional universal life policies normally have a fixed floor rate, like a guaranteed floor interest rate. The premiums on these policies are flexible. You can raise them, lower them. Now that's not always good because that can make your policy lapse, which I'll show you in a second. And the death benefit on these contracts, as long as premiums are made at what they call target, the death benefit can be guaranteed to a specific age, like age 100. But what are some of the other variants of this product? Well, you've got variable universal life, which now take away all the guarantees because now you are taking some of the money and investing it in a side fund of mutual funds. And I think some of them have other types of investments, but we'll just call them, you can invest in investments. You can invest into a side account, a separate account they call it, and there are investments. So now you can get market-like returns wrapped inside of a life insurance contract where you got a guaranteed death benefit, but now a lot of those guarantees that you thought you had, well, they're all reliant on the markets. You see, insurance companies love universal life because universal life does a couple things that whole life does not that benefit the insurance company. Number one, every year we get older, right? And every year inside of a universal life, the cost of the insurance gets more expensive. It works like a yearly renewable term insurance policy. So as I get older, every year my cost per unit of death benefit, or just the cost for the death benefit, goes up. I get older, it goes up. When do you think you're gonna really care about the death benefit in a life insurance contract? Is it today, or is it when you're 80, 90 years old? Probably when you're 80 or 90. And what happens to the cost of the insurance when you're 80 or 90? It goes up a lot because it kept going up slowly as you got older, but it starts going up really fast as you get to the point where you're approaching your mortality date. I like to call that the day we're going to graduate. So universal life has a rising cost of insurance, which now puts a lot of the risk on you, not the insurance company. The other piece of it, let's talk about the normal universal life. They guarantee you an interest rate, but it can go higher than that guarantee. But that is not a risk that the insurance company wears. That is a risk that you wear and is totally determined by the fixed rates out there in the marketplace. So if you're guaranteed a floor of 3% on your universal life, but then all of a sudden you're making 6 because the Fed raised rates, but then the Fed drops rates back down, you're back to 3. So that risk of the rising interest rate or the falling interest rate, 100% on you. In a whole life insurance contract, there's a couple differences, so let's just hit that. Whole life has a level cost of insurance from day 1 to day number 121 in terms of years. Your cost per unit of life insurance or per unit of insurance stays the same. Never goes up, doesn't matter how old you get. So that's a much better guarantee. And the other thing with that is universal life, but now let's go to variable universal life. Your cost is going up, but now you got this unknown of what is the market performance. So variable universal life was really popular, and then after the Great Recession, it wasn't so popular. But a new vehicle was born, one that you all know because every broker and their brother and their broke-ass brother-in-law and sister-in-law are all trying to sell this product because it is the #1 paying commission, and that is called indexed universal life. So what they did is they took a universal life shell, the rising cost of insurance every single year, put the risk on you, the client, not the insurance company, but then they said, we're gonna then allow you a floor rate. Okay, well, they're gonna give you a rate that is the floor. It can never ever go below this. Let's call that 1%. So you can never go below 1%. But then what they're gonna do is they're gonna allow you to participate. Keyword, participate, which means you're not directly investing in it, you are participating through the insurance company in an index. So let's just make this simple and let's just assume that it's the S&P 500. There's all sorts of indexes that they've created out of the mad scientist labs that they've got. But the S&P 500, so let's say the S&P 500 is 12% this year. The insurance company allows you to participate in a percentage of that gain that they made on the S&P 500. But sometimes it's capped at a certain rate, like 10% or 12%, and they control the cap rate. Again, the risk is on you, not the insurance company. If the insurance company does one that's an unlimited cap, that's great, but they can still change things in there. They hold all the levers inside of an index universal life. But the one thing you need to understand, your cost, no matter what, keeps going up. So whether or not you make a bunch in the side account or you don't make a bunch, they're getting paid, and all the risk of the gain is 100% on you. So now we're going to talk about what could go wrong in lapse, a whole life, or any of these universal lives. So let's talk about that. So for here, I'm going to go right to this. How a universal life stays in force. A universal life policy generally stays in force when the cash value and any current premiums are greater or equal to the assessed internal charges on each policy month anniversary. That made all the sense in the world to all of you, right? Right, because I'm still looking at that saying, what does that mean? So let's go to the next one. How does a universal life lapse? You'll understand all this. A universal policy generally lapses after a grace period, because there's always a grace period, when the internal charges, the cost of insurance, the policy service fee, and the commissions exceed the cash value in current premium. Okay, maybe you understood that, maybe you didn't, but let's run through that. So first off, a universal life is a flexible premium. That sounds great from a sales standpoint. Oh, if things get rough, you can reduce the premium. If things are good, you can increase the premium. Listen, they won't tell you, but you can do the same thing with a specially designed and engineered whole life within parameters. But a universal life, this is a big selling feature. Flexible premiums, and they'll always tell you, oh, those whole lives don't have flexible premiums. Wrong. But that's also a terrible thing because they give you all the power to adjust your premiums. So what do you want to do with your premiums on your life insurance? You want to pay the least amount possible. So if you have the ability to reduce that when anything gets rough, what do? You drop the premium payment on your life insurance, your universal life. So how does the policy lapse? Well, we're getting to that. It lapses when it's underfunded. So let me read this. A universal policy is underfunded when it is a path toward a point where its cash value and its current premiums are less than the assessed internal charges. In other words, when your cash value is not growing at a rate higher than the internal costs are going up. Now that might not be a problem when you're younger, but when you're 80, 90, maybe 70, that's a big problem. Because if the markets aren't performing in a VUL or an IUL, but your cost is going up, does anyone sense the problem there? Or now we add that extra element, now you reduce the premium, so now your premium isn't covering the cost of insurance, so now you're relying on the interest to cover it, the performance of the market to cover it, or your participation in that index that the insurance company so allowed you to participate in. If that performance doesn't exceed the rising cost, it's game over. Lapse-a-roo for you. No risk to the insurance company. Again, I'm going to preface, the guarantees are not what they are in a whole life policy, but the risk is definitely put on you where in a whole life, the risk is on the insurance company. Let's keep going. I mentioned this before, but let's just hit on it. The return in a universal life can decrease. The same thing in an IUL. The participation rate that you're getting could come down to the floor. And if the floor is 1%, does that cover your cost of insurance? Did you maintain your premiums? All these are factors. The internal charges in a universal life can increase. Oh, this is interesting. Let me read this. If a policy's premium level is set based on the assumption of a current internal charge, an increase in those charges can cause the policy to be underfunded. The insurance company puts all the risk on you. They can adjust the internal charges on the policy, and that is not in your control. Remember I mentioned the premiums. If they're insufficient to cover the cost of insurance, lapse-a-roo goes you. And also, premiums can be reduced or paused. You have the ability, remember it's all flexible, you can do whatever you want with those premiums. You can do whatever you want, and then when you get the letter that the policy is gonna lapse, who are you gonna blame? Well, the only person you can blame is yourself, because you got super excited that you could reduce the premiums, but now all of a sudden, when you need it, the policy can lapse. Who wins in that? That's right, the insurance company. Because the only way the insurance company loses is you die too soon and they got to pay the death benefit. So the game is the insurance company wants you to live a long time and they want the policy to lapse. That's how they win. But wait, there's more. Because in a universal life, there is a cash value. They pitch this all the time with these IULs. You can take withdrawals from your cash value. Yep, and if you do that, guess what you just did? Affected the ability for the policy to stay in force. Because when you take a withdrawal, if it's a substantial amount, the policy can become underfunded. So now we got all these variables. You see what I'm saying? So when we're talking about guarantees, we don't want variables to interrupt our guarantees, do we? Whole life doesn't have these issues. Death benefit can be increased. So on some universal life policies, you have the ability to have that death benefit go up. But when the death benefit goes up, so does the cost, and it goes up every single year. I could keep going, but universal life has some serious problems. So now let's talk about whole life insurance and the guarantees there. Remember, I told you all the things that can have a universal life lapse. Let's see if those can also lapse a whole life. Coming over here, what can cause a whole life to lapse? How about a decrease in return? Nope, that can't happen. How about an increase in the cost of insurance? Nope. Remember I said the cost of insurance is level the entire time. How about insufficient premiums? Nope, because your premiums are set from day one. And if we design and engineer it the way we do it, you still cannot go below the minimum premium. How about reductions or pauses in premiums? Can't happen in a whole life. How about if you withdraw cash value? Hell, you could withdraw all the cash value from your whole life, and it can't lapse the policy. How about an increase in death benefit? Nope, that can't lapse your whole life. So do you see the difference? Guarantees, well here, all the things that would lapse your universal life, your variable universal life, or your index universal life, they don't lapse a whole life. But there are two things that you could do to lapse a whole life, and I'd be remiss not to hit them. So you could underpay your premium. In other words, you could just not make premium payments, period. And if you did that, yeah, eventually your policy would lapse. Or you could take loans out after loans out after loans out and not be an honest banker like we teach. And if you did that, the loan interest rate, along with not paying premiums, could lapse your policy. So if the loan interest that cannot be capitalized is not paid out of pocket, well, your policy could lapse. So in other words, you take loans, the insurance company sends you a loan interest rate, you don't pay it, you roll it into the loan, you just keep doing that year over year. That would mean literally you're being completely irresponsible, and yes, your policy could lapse. And the other thing that is guaranteed for all policies, has nothing to do with policies, but we're all guaranteed to graduate someday. That is a guarantee we can all count on. But with that, another guarantee I'd like to throw in there is you all should be guaranteed to subscribe to this channel. And also not just subscribing, click the little bell up top. It did it for me. Smash that bell and you'll be notified every time I put new content up. And in closing with this episode, I did want to show you a couple of the numbers because this is how they sell you these universal life policies, or specifically this IUL. So I know a lot of people that sell IUL, so I went to one of the ones I trust and I said, build me the best performing IUL you can, meaning the best cash value. So let's just go through these numbers, and we're not going to get specific, and I'm not going to tell you what company this is, but I did this as a 46-year-old putting $12,000 a year into the policy. So the first year in this amazing IUL that he designed, he said this one reduced my commission by quite a bit. Here's how much cash value I would have. And this is not bad, $9,959. I put 12 in, I have $9,959 in accumulation value. So I'm gonna put that, AV, accumulation value. That's not bad, right? But that's not how much money you can use. Over here is what's called a surrender value. Remember, in a universal life, any universal life, there are surrender charges in the early years, meaning you can't take all the money you have built up in the policy out. And this number is only if this policy performs at 6.25% participation rate. That is not guaranteed. So NG, baby, there is no guarantee that's going to happen. That's just their hypothetical rate. But the surrender value, hold on, is only 8107. So I put 12 in and I can only use 8107. But wait a second, the next year I put another 12 in. The 99 goes up to 20,000. So now, oh, here we go, we're climbing. Well, that's only if I got 6.25. But now out of the 20, I can only use 18,793. So this one, I lost 32%. This one, I'm down 15.24%. I mean, I can keep going. It goes from 18 to 30 to 41 to 54. But over here, this is the one that they're going to show you. It goes from 31,000, 43,000, and then 55,000. See how it's closing in though? So here, and I don't know how many years that is. So 1, 2, 3, 4, 5. This is 5 years later. So now I'm 51 years old here. I was putting 12 in each year, and you guys can do the math, okay, each year. So I had 55, I can use 54. So let's see, 5 years in, I put 60K into the policy. I got 55 in the accumulation, negative 3.33%. This is a universal life that was designed by a friend that understands how to do it, that said to me, this is the best one he could design from a cash value standpoint. Now, I'm gonna bring you over and I'm gonna show you a whole life insurance policy. So now let's look at a whole life. Now I'm not gonna use the same premiums just because I just grabbed an illustration. So now we're gonna talk about a whole life and I just want you to see the differences, okay? Pretty much the same thing. We're gonna start with a 46-year-old, but now 20,000. Listen, don't get hung up. The dollars don't make a difference, whether it's 12 or 20. Yes, the numbers look different, but we're looking at the percentage. That's what we're looking at. So here, over on the, and again, I'm going to use the non-guaranteed side, which includes a dividend. Okay, so we do understand that this is not guaranteed, but a lot of it is. I'll give you the guaranteed side in a second. This is the guaranteed side. So we put in 20. We have 14,000 used on the guaranteed. On the non-guaranteed, we have $15,543, okay? So what does that mean? Well, that means we had 77.72%. So not too much different, a little better than the universal life, but hold on, let's go the next year. Put 20 in, I'm guaranteed, I got 30, okay? Then over here on the non-guaranteed side, what do I got? I got 18,402, so I'm down 8%, okay? Over here I was down, what is that, 32? So over here, on the first column, I apologize, I forgot to give that to you. So we're down over here 23%. How much was it on the first one? More than that, right? Let's just double check. On the universal life, we were down over 30%. Now we're down 23%, so a little bit better. All right, let's keep going. We're gonna go right up to the same, and I'm gonna do these rapid fire, okay? So 46 to 51, because we're doing the same one. So, and we're gonna go away from guarantee, and I'm just gonna come over here. 48. On this one, I got 19,000, okay? So that means I lost about 4%, I'm rounding down, okay? Because we're always putting 20 in, 20, 20, 20, 20, okay? Got 19 there. The next year, 49 here, we got 20,000, 323. So now I'm positive. I made 1.62. So I'm doing better than I was in that universal life, especially if I looked at the surrender value. Then I go down to 50 years old, and I've got 21,434. So now I made 7% this year, 7.2. And then I go to 51 the final year, and 51, I've got 22,000, put 20 in, take out 22,602, I made 13%. So now let's just compare the two. And remember, this whole life has a lot more guarantees than the universal life does. But let's just compare numbers. Plus 13 at 51. And what was our universal life? Negative 3.3, okay? So, and that was a universal life if you can get your guy to do it. And also too, I want to preface, that is if the policy earns 6.25, and on the guaranteed whole life, that is if the policy pays a dividend. So folks, you can see when we compare the two, the IUL and the whole life, even a very specially designed and engineered IUL versus a specially designed and engineered whole life, the whole life wins. But it doesn't just win by the numbers, it wins by the guarantees that I just showed you. It can't lapse nearly the way a universal life can lapse. This policy, you could lapse very easily. A lot of variables like the rate, the flexible premium, all of those things I mentioned, the rising cost of insurance, all those things weigh into the universal life. None of those factors affect the whole life. So folks, when we're talking about guarantees and you want a safe place for your money to go guaranteed and you want good returns, I think conclusively with those two examples, if we could do a lot more, you will see the whole life wins. But it doesn't just win sometimes, it wins every time. Folks, with that being said, thanks for joining us for this episode. Put your comments below, and if you like this video, you're gonna wanna check that one out right there, BYO Bank. We'll see you next time.